Most traders think adding to a winning position is simple. They believe that if a stock moves up, buying more is just the next logical step. Here's the brutal truth. 9 out of 10 amateurs destroy their accounts trying to pyramid too early, too aggressively, or without a plan. The market doesn't reward impatience or wishful thinking. It punishes it mercilessly. Jesse Livermore, one of the greatest traders in history, called this the art of compounding fear and greed. He understood that pyramiding isn't about luck or boldness. It's about precision, mental control, and calculated risk at every stage. While amateurs chase the tape, professionals wait for confirmation, then layer positions methodically, like building a structure that can withstand a storm. Consider this distinction. An amateur adds to a winning trade because they feel excitement. Their decision is emotional, impulsive, and often fatal. A professional adds because the tape confirms a pivot, because risk is measured, and because the position sizing is optimal. That subtle difference is the boundary between turning $10,000 into $50,000 or turning it into zero. Livermore's secret wasn't some mystical talent. It was disciplined observation and carefully calculated action. He treated each layer not as a gamble but as a controlled experiment, each addition validated by price behavior and volume. The first position isn't about profit, it's about testing the waters. Most traders never realize that the first layer is the most important. It's where amateurs make their fatal errors. They panic when a pullback occurs, or they double down without waiting for proof. Professionals, in contrast, see the first layer as a statement. The market has passed its initial test, and now, carefully, they prepare to add. There's a key rule Livermore swore by: never double your position on a whim. Double only when your prior trade proves that the market is alive. This is counterintuitive because it feels safer to rush in when things are moving in your favor. The real safety lies in patience, observation, and confirmation. Think about the psychology at play. Fear of missing out tempts amateurs to act prematurely. They see a price move, a breakout, or a rally, and their mind screams, "Get in now, or lose the opportunity." Professionals, however, respond differently. They understand that doing nothing is sometimes the most profitable move. Waiting for a pivot, a pullback, or a confirming candle is not hesitation. It's discipline. The first position is never about making money immediately. It's about learning the rhythm of the market, understanding its behavior, and letting the trade prove itself. Let me tell you a story. Livermore entered a position in cotton early in a volatile season. He could have added immediately after a small uptick, but he waited. Day after day he observed volume, watched price consolidation, and let the market reveal its true trend. Only when a decisive breakout occurred did he add to his position. By layering after validation, he avoided catastrophic reversals and set the stage for massive profits. The lesson is clear. The first ADD is always a test, not a payday. If it fails, the loss is manageable. If it succeeds, you have the foundation for careful pyramiding. Here's a maxim to remember. The market will always challenge your impatience. It will tempt you with sudden moves, big candles, and spikes in volume. Amateurs jump, chasing momentum and emotion. Professionals watch, measure, and respond only when the rules align. The difference is subtle, almost invisible, but it's what separates a trader who compounds wealth from one who compounds losses. You might be wondering, what exactly is this hidden rule Livermore used to pyramid safely? It begins with the first position but extends beyond it, shaping every layer that follows. By now, you should see that pyramiding is not reckless doubling. It's a methodical, step-by-step discipline. The initial trade, the first layer, sets the tone for every add-on. It teaches patience, enforces respect for risk, and introduces the most crucial mindset of all. Trading is not about ego or excitement. It is about process and observation. By the end of this journey, you'll understand why most traders fail when they try to pyramid, and why following Livermore's step-by-step system allows even small positions to grow exponentially without catastrophe. The first layer is invisible to most traders because it's more about restraint than action. But restraint, as you'll soon see, is where real power begins. The market rewards those who wait, measure, and validate, and punishes those who rush, guess, or let emotion lead. The next step, the step professionals use to turn a validated first position into a controlled, compounding pyramid, is where the real secrets lie. It's where small wins transform into exponential profits. And in the following segment, we will uncover that step, showing exactly how to move from patience to precision, from observation to action, in a way that can turn the most disciplined trader into a market legend. The first position is in. The initial trade has proven itself, and now comes the most delicate step, adding the first layer. This is where amateurs make their first critical mistake. They see the price move, feel a surge of confidence, and rush in without waiting for confirmation. Professionals, however, understand that pyramiding begins with validation, not excitement. Jesse Livermore often said, "The tape is your mentor. Watch, don't guess. The market communicates in subtle signals, pivot points, volume spikes, and price behavior. Ignoring these is the quickest path to failure. Imagine you bought 100 shares at $50. The price rises to 52. An amateur's mind says, "It's going up. I must add more." That's impulsive, reckless, and statistically fatal. A professional waits. They watch for the tape to confirm strength, observing if the market can hold gains through a pivot or retracement. This validation step is not optional. It's the foundation for every successful pyramid. The first ADD is never about making money immediately. It's a test. If the market passes it, you have a green light to proceed. If it fails, your loss is small, contained, and survivable. Here's how Livermore approached this first layer. He entered positions conservatively, letting them prove themselves over one or two pivots. He looked for confirming volume and consistent price behavior. Only when these criteria were met did he add to his position. The add-on is not arbitrary. It's structured, calculated, and aligned with the rhythm of the market. He treated each layer like a brick in a building. The first brick must be solid, or the whole structure collapses. Most traders underestimate the importance of this validation. They see a breakout and assume momentum will carry them forward. Professionals know that a breakout alone is not enough. They watch for volume to confirm the move, for minor pullbacks to test the trend, and for the market to display resilience. By observing these signals, the professional ensures that each add-on is supported by market reality, not hope. It's counterintuitive. Sometimes doing nothing is the most profitable move. Sitting on a validated first position, waiting for the next pivot, and observing the tape is discipline, not inaction. An anecdote from Livermore's career illustrates this perfectly. In a cotton trade, he entered early and watched the market hesitate. The amateurs around him panicked or doubled impulsively. He held, observing volume and price behavior, waiting for confirmation. When the breakout finally occurred, he added precisely at the right moment, and the resulting layers compounded profit without excessive risk. The key lesson: the first ADD is a test. Treat it as such, and your risk is controlled, your psychology intact, and your foundation secure. Maxims anchor this mindset. Your first ADD is proof, not profit. Validation precedes accumulation. Professionals layer only when conditions are met. Amateurs layer because they feel lucky, greedy, or impatient. That subtle difference dictates whether the pyramid grows or collapses. It's the invisible boundary separating success from ruin. Every trader faces this moment, the first chance to add to a winning position, and the way they handle it determines the trajectory of the entire trade. Now consider sizing. The first ADD is never equal to or greater than the initial position. Livermore taught that the second layer should be smaller, proportional to risk, and aligned with confirmation. This is why amateurs fail. They double down, exposing themselves to catastrophic loss if the market reverses. Professionals think in percentages, not gut feelings. Each layer is a controlled risk, never exceeding 2 to 3% of total capital per step. The first ADD is about validation and preparation for subsequent layers, not chasing a quick gain. By now, you should see a pattern emerging. The first position validated, the tape confirming strength, and the first ADD sized correctly form a disciplined triad. The market will always test your patience, challenge your ego, and tempt you to act impulsively. Fear of missing out is relentless, but discipline is relentless too. Professionals respond to rules and signals. Amateurs respond to emotion. Master this first ad, and you've created a foundation for safe compounding pyramids. Yet there is more. After the first layer, a trader must consider how far to continue, when to adjust stops, and how to maintain mental clarity as positions grow. The first layer is only the beginning of a structured process that can transform small wins into exponential growth. It teaches patience, observation, and respect for risk. Without it, every subsequent layer is gambling. With it, the pyramid becomes a precise, controlled strategy. The next step, the secret formula for calculating subsequent layers and adjusting position sizes to compound gains without overexposing capital, is where the real magic of Livermore's system lies. By understanding the first ADD and its validation, you are now ready to see how professionals construct pyramids that grow steadily, confidently, and profitably. The first layer is complete. The next step will show how small, disciplined additions turn an ordinary trade into a legendary performance. Now that the first layer is validated, the focus shifts to building the pyramid strategically. This is where amateurs lose control and professionals separate themselves. Adding subsequent positions is not about greed, it's about precision. Jesse Livermore's genius was in understanding that each additional layer must be calculated, proportionate, and justified by the tape. Pyramiding is not an impulsive act. It is a disciplined sequence, each step measured and intentional. The initial trade has passed its test, but every additional layer carries new risk. How you manage that risk determines whether the trade multiplies wealth or erases it. Consider the psychology at play. The first ADD has gone well, your account looks healthier, and confidence rises. An amateur sees this as permission to go big, to double or triple positions on impulse. Professionals respond differently. They understand that risk compounds with each layer, and overcommitting is the fastest route to ruin. Livermore's approach was simple. Each new layer is smaller relative to the prior one, proportional to confirmed strength and controlled risk. This is why pyramiding works for professionals and fails for amateurs. Discipline, not emotion, drives growth. Let's imagine a scenario. Your first position was $10,000. The first AD'd $7,000. The second AD'd $5,000. Why smaller? Because risk is cumulative. If a reversal occurs, the losses on smaller layers are manageable. If the trend continues, the profit compounds elegantly. Livermore treated each layer like a building block, each smaller than the last, creating a structure that could withstand inevitable market volatility. Stop losses move in alignment with each layer, ensuring that the total risk is controlled. Amateurs ignore this, doubling blindly, gambling their capital and confidence. Here's a critical maxim: pyramid small, cut losses fast, and let winners run long. This isn't a catchy phrase. It's a principle that governs professional behavior. Each layer is added only when the tape confirms the trend, each stop, loss is adjusted, and each position is sized to protect the core. Professionals think in percentages, not in emotional impulses or gut feelings. They know that the total pyramid is more than the sum of its parts, and careful construction allows compounding without reckless exposure. An anecdote from Livermore illustrates this vividly. In a multi-layered cotton trade, he added positions gradually over 5 layers. The first 2 layers were confirmed by minor pivots. The third layer required volume confirmation. The fourth was a test of market resilience. And the final layer was added only after the tape exhibited clear strength. By the end, his total position was significant, yet his risk never exceeded his initial plan. Amateurs around him panicked at each retracement, either liquidating too early or adding too aggressively, losing both capital and confidence. Another counterintuitive insight: sometimes doing nothing is the most profitable move. Between layers, a professional waits, observes, and adjusts. The tape may consolidate, fluctuate, or test prior pivots. Amateurs misinterpret this as hesitation or weakness. Professionals understand it as the market's natural rhythm. Waiting is a form of action. It preserves capital, confirms strength, and sets up the next layer under ideal conditions. The ability to observe without acting impulsively is a hallmark of professional pyramiding. Position sizing must always be tied to risk, not desire. The first ADD validated the trade. Subsequent layers must respect cumulative exposure. Each position added is a calculated extension of the original trade. This is why amateurs fail. They ignore the arithmetic of risk. Professionals calculate not just the potential profit, but the potential loss, ensuring that the pyramid can survive reversals while maximizing opportunity. Livermore emphasized discipline over intuition, numbers over emotion. Each layer is methodical, deliberate, and controlled. By now, a pattern emerges. The first layer validated the trade. The second and third layers compound cautiously, observing the tape and adjusting stops. The pyramid grows, but under strict supervision of risk and psychology. The market is never predictable, but disciplined construction converts uncertainty into a controlled opportunity. Every professional trader knows that pyramiding is not a gamble. It's structured compounding. The next step, after building the layers, is mastering the psychology of the pyramid. As positions grow, stakes rise, and emotions intensify. Fear of drawdown, greed for more, and the temptation to deviate from rules all become critical challenges. Professionals maintain composure, amateurs succumb. Understanding how to layer safely primes you for managing the mental battlefield ahead, where discipline becomes the true source of wealth. The stage is set. You have built a foundation, added layers with precision, and now the mind must follow the method, or all gains risk collapse. Even the most perfectly constructed pyramid can collapse if the trader's mind falters. Fear and greed are relentless forces that destroy discipline, erode judgment, and turn calculated trades into reckless gambles. Jesse Livermore understood this better than anyone. He knew that controlling your own emotions was as important as controlling your positions. Amateurs react to price spikes or sudden pullbacks, letting fear of loss or greed for more dictate action. Professionals, in contrast, respond to signals, not emotions. They follow rules, respect stops, and observe the tape without attachment to profit or loss. The psychology of a pyramid is unique. As positions grow, so does the mental pressure. Your account looks larger, your stakes increase, and the temptation to deviate from your plan becomes almost irresistible. Amateurs panic when a minor reversal occurs, sell prematurely, or add recklessly, trying to chase momentum. Professionals recognize these psychological traps and build safeguards around their behavior. Livermore often said, "Markets are never wrong, opinions are. Your ego, your hopes, and your fears do not belong in the trade. Only your process matters." Imagine a pyramid that has grown across 4 layers. The market hesitates, volume slows, and a small retracement occurs. Amateurs see this and think disaster is imminent. They liquidate, or worse, double down impulsively. Professionals pause, they observe, they review the tape, check confirmations, and evaluate the behavior of the market without reacting emotionally. Their stops are preset, their risk contained, and their psychology aligned with the plan. This mental discipline allows them to survive turbulence and capitalize when the trend resumes. Livermore faced this scenario repeatedly. In one significant cotton trade, after 3 layers, the market pulled back unexpectedly. Amateurs panicked, selling everything in fear of a reversal. Livermore held, trusting the process, letting the stops protect the core, and observing the tape for confirmation. The market eventually resumed its upward trajectory, and the final layer multiplied profits dramatically. The lesson is clear: emotional control is not optional, it is mandatory. The tape is the market's language, and only a disciplined mind can interpret it correctly under pressure. To maintain composure, professionals establish routines. They define emotional triggers, such as fear of drawdown or greed for extra profit, and set predetermined responses. Stops are adjusted automatically. Add-ons are rule-based, not whim-based. They focus on the tape, not their P&L. Observation becomes an active strategy. Waiting in this context is not inaction. It is the most potent form of trading. Sitting calmly while the market tests your pyramid ensures that subsequent decisions are based on data and confirmation, not emotion. Here's a maxim to anchor this mindset: you cannot control the market, you control your process. Every rule learned so far, validating the first position, sizing layers correctly, adding only with confirmation, depends on the trader maintaining composure. The pyramid magnifies not only gains but also emotional pressure. Each layer tests your ability to follow rules, manage risk, and resist the urge to act impulsively. Amateurs fail because they lack this mental structure. Professionals succeed because they enforce it rigorously. Pattern interrupts are crucial here. The market will test patience repeatedly. There will be moments when doing nothing feels wrong, when waiting seems cowardly. This is exactly when professionals thrive. The tape is active. The pyramid is exposed, yet restraint becomes a tool, not a limitation. Observing without acting preserves capital, reinforces discipline, and sets up the next opportunity. Each pause is a lesson in control, each confirmation a reward for patience. The psychology of the pyramid also reinforces prior lessons. Remember the first layer? It was about validation. That same principle applies psychologically at each subsequent layer. Each add tests your patience and reinforces your discipline. The more layers you construct, the greater the pressure and the more important it becomes to separate ego from process. Fear and greed are amplified, but rules and observation act as a counterbalance. Mastery of these mental dynamics transforms pyramiding from a technical method into a reliable skill. By the end of this stage, you understand that trading is as much a mental exercise as a mechanical one. The first layer proved patience, layering demonstrated calculation. Now psychology ensures survival. The final step, which we will cover next, is the strategic exit, locking in profits and consolidating gains without sacrificing the exponential benefits of a disciplined pyramid. This step completes the process, connecting validation, controlled layering, and mental mastery into a cohesive system that separates professionals from amateurs. Only with psychological discipline can a pyramid reach its full potential. The final, and often most neglected step in professional pyramiding is exiting the trade strategically. Building a pyramid with precision, layering correctly, and maintaining psychological discipline are all critical, but they are meaningless if you fail to close positions intelligently. Most amateurs ride greed into reversals, watching profits evaporate and panicking at the first sign of pullback. Professionals, however, approach the exit as methodically as they approach the entry. Jesse Livermore emphasized that a trade is never complete until the pyramid is unwound in alignment with the market's behavior, protecting gains while letting the final fraction run for maximum effect. Exiting is not a single action but a process. Professionals take incremental profits at key pivots. They adjust stops after each add-on, moving them to break even or beyond, ensuring that even if the market reverses, losses are minimal. The final layer is allowed to run with trailing stops, capturing the largest possible gains without jeopardizing the foundation. Amateurs, by contrast, sell everything at the first hesitation, surrendering potential exponential growth. Livermore's genius was in balancing patience with protection, knowing precisely when to take partial profits and when to let a position ride. Picture a pyramid built across 5 layers. The market reaches a key resistance level, and you're first. Instinct might be to liquidate everything. The amateur sells outright, terrified of losing gains. The professional, however, takes partial profits at this pivot, secures a portion of the gains, and lets the remainder continue with a tight trailing stop. When the market continues upward, the last fraction compounds dramatically, turning what could have been an ordinary win into an extraordinary one. Each step is deliberate, calculated, and disciplined. There's a maxim that defines this stage: cut losses fast, size small, wait, own the process. Every rule from initial entry to final exit reinforces this principle. The pyramid rewards those who respect the structure, follow the tape, and maintain emotional control. Amateurs treat trades like bets. Professionals treat them like carefully managed experiments. The exit is where discipline converts potential into realized results, where patience compounds into profits, and where the system proves itself. Strategic exit also ties all previous lessons together. The first layer taught validation. Subsequent layers taught controlled compounding. Psychological discipline ensured survival. Now, the exit consolidates the work, translating careful construction into tangible outcomes. Every pivot, every stop adjustment, and every fraction allowed to run reinforces the mindset that trading is about process, not luck. Professionals understand that the market never gives guarantees. It only rewards those who follow rules with patience and precision. Livermore's approach to exiting pyramids was almost surgical. He monitored price behavior closely, adjusted stops dynamically, and took profits in a way that maximized compounding while minimizing risk. He treated each trade as a living structure, observing and interacting without emotion. Amateurs, lacking this discipline, often panic-sold or added recklessly at the wrong moment, destroying both capital and confidence. The contrast is stark. One group compounds wealth steadily, the other compounds mistakes rapidly. Even during the exit, pattern interrupts and counterintuitive strategies matter. Sometimes the best decision is to do nothing and let a position run with a trailing stop. Amateurs interpret hesitation as weakness, yet professionals see it as an opportunity to protect the pyramid and ride the trend to its fullest. Observation remains critical. Each pivot and retracement is a test of both the market and the trader's discipline. Mastery is in responding to rules, not reacting to emotion. By now, the pyramid is complete. The first position validated the trade. Subsequent layers compounded gains under strict risk management, and psychological discipline ensured survival. The exit transforms all these elements into results. You have learned to pyramid like a professional. Start small, validate, add layers carefully, control emotion, and exit strategically. This full cycle separates amateurs from legends. The hidden rule Livermore relied on, structured, disciplined, and step-by-step, has now been revealed in its entirety. The final actionable takeaway is simple: cut losses fast, size positions wisely, wait for confirmation, and always own your process. The pyramid is more than a trading technique. It is a lesson in patience, discipline, and controlled compounding. Applied correctly, it transforms small, validated trades into extraordinary outcomes without exposing you to unnecessary risk. This process bridges validation, layering, psychology, and exit strategy into a cohesive system that professional traders use to create consistent, exponential growth. As you move forward, remember that this method is repeatable. The pyramid is not a one-time tactic. It is a framework. In the next video, we will explore how the same principles can be applied in reverse through short-selling pyramids, opening up exponential opportunity even when markets decline. By mastering this cycle, you transform from an amateur reacting to emotion into a professional, executing with precision,